Let's face it, no one likes paying taxes, right? And no one really likes SARS either, as SARS often feels like that big schoolyard bully that comes around every single month to beat you up and steal your lunch money.
Everybody was kung fu fighting!
So what if I tell you that there is actually a way that you can legally point the proverbial finger to SARS and save you a ton of taxes just by following a simple strategy: entering a tax-free savings account. Although I've talked a lot about tax-free savings accounts in the past, heck, I have a whole playlist over here. In today's video, we are going to hone in and see exactly how much taxes you can expect to save within a tax-free savings account. Not only is this important to know in order to motivate you to open a tax-free savings account, but it is also crucial to understand how different investment strategies will play out in a tax-free savings account over the long run in order to try and figure out which one will reign victorious over the others. I'm going to touch on a bunch of important investment principles in this video, especially when it comes to taxes. So do yourself a favor and watch this video all the way to the end so that you can become empowered to decide which tax-free savings account strategy will work best for you. Alright, so let's just quickly recap on what exactly a tax-free savings account is. A tax-free savings account is an investment product that our beloved government introduced in 2015 to help encourage South Africans to save more money. As the name suggests, the whole purpose behind this account is to basically save taxes. But unfortunately, because our beloved government decided to call it a savings account, many South Africans do not really understand how it should be used, and even worse, what exactly they should put inside of their tax-free savings account in order to maximize their tax savings. I mean, in the end, the more money you save on taxes, the more money you have available to invest, and therefore the quicker you can grow your wealth, right? Right, so how exactly do we save on these taxes? I'm sorry to break it to you, but even after you have paid taxes on your income as well as the things you buy, the government will still want its slice of pie on the growth of the little money you have left over to invest every single month. And they steal your two broekies in 3 different ways. So before we dive deeper to see how many taxes we can actually save inside a tax-free savings account, we must first understand how these taxes are calculated in the first place. Firstly, when you sell your investments for more than what you bought them for, you will be taxed on the difference, which is called a capital gains tax or CGT. So how this works is, let's say you bought 10,000 Rand worth of shares in 2010 and then sold it for 100,000 Rand in 2020. The difference, or in other words, your profit on these investments will then be 90,000 Rand. Now, every single South African does get an annual CGT exclusion of 40,000 Rand, which basically means that on the first 40,000 Rand of capital gains that you incurred, you won't have to pay any taxes. So this brings us to 50,000 Rand. Now, after deducting the 40,000 Rand exclusion, 40% of this difference will then be taxed according to your marginal tax rate, which ranges anywhere from 18 to 45%. Your marginal tax rate is calculated based on how much income you receive for the year, and these tax brackets can be found on the SARS website. So if you take 40% of 50,000 Rand, we are left with 20,000 Rand that will be taxed according to your marginal tax rate. If you fall within the lowest marginal tax rate, which is 18%, you will pay 3,600 Rand in taxes. And if you fall within the highest marginal tax bracket, which is 45%, you will pay a whopping 9,000 Rand in taxes. Another way to calculate your CGT liability is to multiply 40% with your marginal tax rate. So, for example, if you are in the lowest tax bracket, then 40% of 18% is 7.2%, and if you are in the highest tax bracket, then 40% of 45% is 18%. So, in other words, the capital gains tax that you will pay on your investments will range anywhere between 7.2 and 18% after subtracting the 40,000 Rand annual CGT exclusion. Alright, so the second way that the SARS and government bullies will steal your pepper steak pie is by taxing you on the interest that you receive on your investments. So when you deposit money into your bank savings account, money market trust, money market fund, fixed deposit, government bonds, or retail savings bonds, your money will grow by earning an interest that is based on a predetermined interest rate. So let's say you deposit 1 million rand in a fixed deposit with an interest rate of 10%. After a year, you would have earned a lekker 100,000 rand in interest. But what is not so lekker is that SARS will also want to take a hop out of that interest bar you earned. Now, similarly to capital gains tax, every South African also receives an annual tax exemption of 23,800 rand if you are younger than 65 or 34,500 rand if you are older than 65. So let's assume that you are not yet an old bully, so therefore younger than 65. You will have to pay interest tax on 100,000 rand minus the 23,800 rand exclusion, which is 76,200 rand. Now this difference will be added to your income and then taxed according to your marginal tax rate, which again ranges from 18 to 45%. This is not a lekker tax to pay, as when compared to CGT, which peaks at 18%, your interest tax can actually go up all the way to 45%. And what's even worse is when this interest is added to your normal income, it can actually push you into a higher tax bracket, which means you will pay more taxes on both your income and the interest earned. Okay, so if you're not yet crying, then I'm sure you will after SARS takes your Coke and backwashes it with the withholding taxes that it charges on the dividends that you receive on your investments. When you invest in a company and that company makes a profit, the company can decide to either reinvest it into the company to help it grow, or they can pay it out in the form of a dividend to its shareholders, which are you and me, in order to kind of say thank you for trusting them with your hard-earned money. Now, dividends are taxed at a flat rate of 20%, regardless of which marginal tax rate you fall into, and you do not get an annual dividend withholding tax exclusion as you do with CGT and interest tax. So, to summarize, under normal circumstances, you will be paying capital gains taxes of between 7.2% and 18% after subtracting the 40,000 rand annual CGT exclusion, 18 to 45% interest tax on interest you receive after subtracting the 23,000 annual interest tax exclusion, and 20% dividend withholding taxes on the dividends that you receive from local companies. Right, so now that I gave you a headache with all of this mathematics, I can finally reveal why a tax-free savings account is so powerful. Within a tax-free savings account, you do not have to pay any capital gains taxes on either your local or offshore capital gains, which means a saving of up to 18%. You will not have to pay any interest taxes on either your local or offshore interest earnings, which means a saving of up to 45%. And you do not have to pay any dividends that SARS would normally charge you, which is 20% on local dividends and usually 5% on offshore dividends. And on top of all of these, you do not have to pay any securities transfer taxes within a tax-free savings account, which is usually around 0.25% on all of your purchases. Right, so now we finally reached the juicy part. How much taxes can you expect to save within a tax-free savings account? Now, the amount of taxes that you will save will mainly be based on what you choose to invest in within your tax-free savings account, or in other words, your underlying investments. So let's look at 4 different investment strategies to see how they compare with each other. In each scenario, I'm going to assume that you will invest your full 36,000 rand per year in order to reach your 500,000 rand annual contribution limit after 13 years, and then leave your money for another 17 years to be invested for a total period of 30 years. I'm going to use this very cool interactive calculator from the My Money Tree website to show you the numbers, so big shout out to Walter for creating this free tool. I will leave a link down in the description for this tool so that you can go and play around with the numbers to fit your individual needs. First up is an investment that will earn you interest, which can again either be a fixed deposit, retail savings bond, money market unit trust, or just a normal bank savings account. if we assume that you earn an interest rate of 7% and that you are in the highest marginal tax bracket of 45%, then after 30 years, you would have saved a total of 619,400 Rand in interest taxes. Now this may sound like a lot, but the reality is that because you already receive the 23,800 Rand annual interest tax exemption in any case, you will only really start benefiting from the interest tax savings within a tax-free savings account after about 8 years. Or in other words, you would have wasted 8 precious years of tax savings because you already received the interest tax exemption whether or not your investment was inside a tax-free savings account wrapper. Hence why you should not put interest-bearing investments inside a tax-free savings account unless perhaps you have other investments that earn interest in excess of the annual interest tax exemption threshold and if you are in a very high tax bracket. Next up is an investment in local equity such as the Satrix Top 40 ETF. Because you are invested in shares, not only do you receive dividends from the companies that you invest in, but you will also realize a capital gain once you sell your shares at a profit. Now, if we assume that your local equity investments pay out an average of 2.5% in dividends every single year, and that we can expect an annual growth of 9%, then after 30 years, you would have saved 317,000 Rand in dividend taxes within your tax-free savings account. But where the real tax benefit comes in is when you sell your shares at a profit, which means that if you are in the 45% tax bracket, you will save a whopping 1 million Rand in capital gains taxes. And if you add the two together, an investment in local equity will likely result in a total tax savings of 1.3 million Rand over the 30-year period. Now let's look at the anomaly of property investments. Property ETFs track the performance of real estate investment trusts, aka REITs, and these REITs tend to have very high dividend payouts of around 8% per year. But because of the way in which REITs are structured, the dividend payments that you receive from REITs, which is usually funded by rental income, is directly added to your income and then taxed according to your marginal tax rate, which I'm sure that we all know by now is the worst kind of tax. But because these REITs are within a tax-free savings account, you don't have to worry about it. And therefore, after 30 years, you can expect to save a whopping 1.9 million Rand in REIT income taxes. And in addition to this, your property investments will likely also grow in value. So if we expect an annual average growth of 2.5% in addition to the dividends being reinvested after the 30 years, you will also save 232,000 Rand on capital gains taxes, which brings it to a total of 2.2 million Rand in taxes saved. So what about investing in foreign equity using a Rand denominated offshore ETF such as the Core Shares Total World? Unfortunately, despite having these funds inside of your tax-free savings account, you will still need to pay the foreign dividend withholding taxes. This topic becomes really complicated as the amount that you will pay will be different depending on where your fund is domiciled in. But in order not to bore you to death, we will just assume that you won't save anything on dividend withholding taxes on these offshore ETFs. So does this make these offshore ETFs then useless within a tax-free savings account? No, definitely not. Because your returns on these offshore ETFs are based both on the growth of your investments as well as the fluctuation between the Rand and the dollar, and seeing that companies from overseas tend to deliver higher returns than our local companies in South Africa over the long run, and that the Rand has historically weakened at a rate of between 2 to 4% per year against the US dollar, you can expect much higher capital gains when you eventually decide to sell off these investments. So if we assume an average return of 11% on these foreign equity investments, you can still expect to save around 1.1 million Rand in taxes after the 30-year period. Alright, so based on these calculations, the investment strategy that will save you the most amount of taxes inside of a tax-free savings account is property investments. And what is also interesting is that it seems like local investments in property and equity will likely outperform offshore equity because of the fact that you won't be saving any taxes on the foreign dividends. So based off of the assumptions that I made in this video, a tax-free savings account is actually much more favorable for local investments rather than offshore ones. But although tax savings is an important factor to take into consideration, it should not be the main driver that dictates your investment portfolio allocation. Over the long run, equity has outperformed property investments, and therefore the capital gains that you'll realize from equity investments will likely be higher than the dividends that you'll receive from property investments. And the other crucial thing to remember is that if the rand weakens against the dollar, which it historically did, your offshore investments will give a much higher return in rand value. So there isn't really a clear-cut answer as to which strategy you should follow inside your tax-free savings account. While I personally won't consider any interest-bearing investments inside my tax-free savings account, I do think that a strong argument can be made for having a blend of property and equity investments in both the local and offshore markets. So for me, personally, I decided on splitting my tax-free savings account as 40% local equity, 40% offshore equity, 10% local property, and 10% offshore property. But if you want to keep things simple, then you can't really go wrong by choosing a well-diversified offshore ETF such as the Core Shares Total World or the Satrix MSCI World ETF. With that said, for many investors, a tax-free savings account only plays a small part in their overall investment strategy. So, for example, if you already have an RA, some fixed deposit investments, and other equity-based discretionary investments, and you are lacking some property exposure, then you can use your full tax-free savings account allocation to invest in property, as we've seen, this will give you the best tax savings potential over the long run. This is a bit more advanced stuff, so if you are not really a numbers nerd like me, then you don't really have to worry about this. But it is an interesting concept to consider for those who want to try and optimize their investments as much as possible. But yeah, as with any investment decision, your asset allocation should be based on your individual risk tolerance and your individual investment time horizon. And if you want to figure out what exactly yours is, then make sure to go check out this video. So let me know down in the comments what your tax-free savings account strategy is. It is always lacquer for me to hear what your guys' thoughts are, and hopefully we can all learn from each other in this awesome community on YouTube. Thanks for watching, guys. Have a lacquer one. Cheers.